Hey, what's up everyone? Bill Lethman here for Money Evolution. In today's video, I'm going to be talking about how to evaluate your investment returns. And this is a very big topic of conversation here. It's very important for you to understand how you're performing, but also to know what to compare yourself to. Because I think oftentimes we kind of fall into this trap where we see, hey, our portfolio is not doing what we either think it should have done in our head, or maybe we see something else that's doing better. And it's important to understand, well, why is it? Why is our portfolio maybe underperforming? And maybe think a little bit more about the process that we're going to go through to choose the investments, whether that's your process, if you're picking your investments on your own, or you're hiring a financial advisor like us to help you put together that portfolio, or maybe you're buying something through work. Maybe you're buying something like a target date fund. Those are all the different kinds of ways that you can kind of put together a portfolio, and it's important to understand how that is being constructed. And what we're talking about here really is asset allocation. And so if we think about the kind of the different layers, if you will, of how the portfolio is constructed, the first layer is going to be what we call our kind of broad asset categories. And those are going to be things like stocks, bonds, and that's probably the thing we see the most often. We see, how are we going to essentially split our portfolio between stocks and bonds? If we're more aggressive, we might want to have more money in stocks. If we're going to be more conservative, we might have more money in bonds, just as kind of a rule of thumb there. But we can also have things like international stocks. Maybe that's a different category there. And international stocks, they tend to be more global and go up and down together with U.S. stocks, but there are times when international stocks might do better than the U.S. stock market, and there's times when the U.S. stock market might do better than international. We can look at things like commodities, and alternatives, things like gold or silver, oil as another investment category there, and even cash, okay? Because there is times when, at least our firm, we advocate having cash in the portfolio. If none of these other categories are working, then we might just want to simply have cash. And so the biggest thing that's going to have an impact on our returns is going to be how we're allocated across these different investments. So if we have a portfolio, just an example here, we think about our 60-40 retirement that a lot of people talk about, 60% stocks and 40% bonds, and we're saying, hey, I'm not happy with the performance of that, or I see another portfolio that's doing much better. Well, it might be because that portfolio is 80-20, and so it's got a much smaller percentage of the money that's in the bond market, and a much bigger percentage of the portfolio that's going to be in the stock market. So that is one thing that would have a huge impact on our returns. So we want to understand that from a broad asset category. The second thing is we want to look at, let's just focus on the stock category here. And if we think about stocks, most of us, if we turn on the nightly news, we see things like the Dow Jones Industrial Average, probably the most popular of the indexes, but we also see things like the S&P 500. And so those become very popular benchmarks and say, hey, the S&P 500, it's 500 companies. It's a very well diversified portfolio. I should, especially if I'm hiring somebody to help me do this, I should at least be able to get the return of the S&P 500. Well, we've talked about that in some other videos, but the S&P 500 is very narrowly focused. It's what's called market weighted, which means that, if we just took 10 stocks out of the S&P 500, it would account for about 20% of all the assets in the S&P. So it's really, probably not a whole lot different in reality from some of the other indexes where it's going to be very heavily concentrated on those top companies there. So the index that you're comparing it to is going to be one thing. But we also want to look at something called style. And when we start breaking this down, and we want to look at something that's going to be diversified, we get into something called the style box. And if we look at that, there's really 9 different areas that we could be invested in. And first of all, we can be in large company stocks, we could be in small company stocks, and we could be in kind of medium company stocks. So we could first of all kind of classify our performance of our account based on the size of the company. And there are times when large company stocks will do better than medium and small company stocks, and there's certainly times when small company stocks will do better than medium and large companies, and even times when medium company stocks will be the best performers. So we want to understand, how we're doing that. And for most of us, we probably want to have some mix generally with those those different categories. And then we also want to look at the style that they might be using for investing. There's something called value style investing, and that's something where those managers or those portfolios are generally put together looking for kind of stocks that may be a good value. Maybe they have a good amount of assets compared to the price of the stock. Maybe their price of the stock is very cheap relative to how much money the company is making. A growth company, on the other hand, they're going to be primarily focused on, how fast is this company growing? What are the prospects of that? So we take a company, locally here, Ford Motor Company, and we say that's a value stock. So we would look at, how many cars are they selling? How are they doing versus their competition? Ford is probably not going to double the amount of cars that they sell next year. They're probably not even going to double the number of cars they sell in the next 10 years. Okay, so their growth projection is going to be very, very small. They're going to maybe ink out a little bit of market saturation or competition, away from their competitors there. If I'm saying that right, I'm blanking out on the word. But anyway, you get the idea. If Ford can steal a little bit of their competitors' business, they're going to grow a little bit, but they're probably not going to grow that fast. You take a company like an Amazon as an example, or a Netflix, and those companies are in a much different position because Amazon is continuing to go out there and they're getting involved in new businesses. And Netflix continuing, as an example, to go out and buy or get new customers. There's a lot of people that don't have Netflix yet that maybe will have Netflix sometime in the next year. So they're kind of still in those expanding markets. And we look at those companies differently. It doesn't mean that Ford is going to do better or worse than an Amazon, or that Amazon's going to do better or worse than a Ford. There's going to be different times when those companies are going to do well. And then the middle category is just kind of a blend. So you get some stocks that might not quite be a value stock. They might not be quite a growth stock. And this is one of the areas that if you look at the historical performance on these different asset categories, lately here in 2019, we've been seeing the growth side of things doing much better. That's been that way for a couple of years now. And it's been mostly large cap growth. Lately, we've been seeing a little bit more in the small cap and mid cap growth as some of the top performing categories. And a real good resource that you can access where you can see this is if you go to the internet, basically type in JP Morgan Guide to the Markets, you'll be able to download a PDF. It's quite lengthy. It's about 40 or 50 pages, so you might not want to necessarily print the whole thing, but put it on your iPad or your computer and kind of scroll through it. Probably within the first 10 or 12 pages, you'll see exactly this, and you'll see the kind of the scorecard for the year, and you'll see how much large cap growth is done, how much large cap value is done, and what you'll tend to see is that performance differences from time to time. And then eventually we will start to see things shift over at some point, and it will lean more towards value. But I say this because you might have a value fund, and maybe you want to have a value fund, maybe because you've decided on a strategy that just has a little bit of everything. And in that value fund, you're saying, gosh, this value manager is just not doing very well. First of all, you might not even understand that it's a value fund. You might just say, hey, it's a stock fund, and this stock fund is not doing as well as this stock fund, and you decide to make a change and sell that fund. Not knowing or understanding why that performance is the way that it is. You go buy the growth fund, and it's maybe just at the time when you've had growth stocks that have been doing this and they're about to do this, and you've had value stocks that have been doing this and they're just about to do this. And so you're swapping out at the wrong time. So that's going to be very, very important to understand the style of that. And same thing with international. So here in 2019, if we go back and we look at some of the numbers, almost no matter which index you look at, internationally speaking, international stocks just have not done nearly as well as the U.S. stock market here. So a lot of people have abandoned international investments and say, hey, you know what, I know these U.S. companies, I understand them, why would I want to buy all these foreign companies? And then you got the trade war going on right now too, so there's even more reason to maybe not buy those. But eventually, international stocks will probably perform well. And so, how do you put this asset allocation together. One strategy is to use something called modern portfolio theory. And this is something that has become very, very popular here over the last, I'd say, decade or two. It goes back to some work done by a gentleman by the name of Harry Markowitz. And he basically did a lot of research, a lot of number crunching there, and looking at correlations of different investment asset classes. And he looked at how stocks were correlated to bonds, and understood that there were times when if the stock market went down, the bond market went up. So those things are not necessarily going up and down at the exact same time. And they obviously go up and down at different amounts. Stocks can go up a lot, they can go down a lot. Bonds can go up a little bit and they can go down a little bit generally, depending on what kind of bond you're talking about, but they're generally going to be a little bit more conservative than stocks. And so modern portfolio theory, maybe you've experienced this. So if you've worked with a financial advisor, or maybe you went in to buy a target date fund, or you did one of these online, they call them robo-advisors now, you filled out some type of a questionnaire, and the design of that questionnaire is to try to understand what level of risk you're comfortable with in your investments. And they might ask you something like, well, what's the biggest loss that you would feel comfortable taking, or enduring, before you hit that panic button and just sell out of everything. So what's the problem with that? Well, a couple of things. Number one is, if you go back and you look at that modern portfolio theory research, it's based off of very, very long time horizons. And in fact, actually, when Harry Markowitz was interviewed, when he was out doing his tour where he was kind of presenting all of his research, somebody asked him one time, said, well, how does modern portfolio theory apply to individual investors? And he kind of paused for a second, and he hadn't really thought about it. He says, it's really not intended for individual investors. And so I think that's kind of ironic, because again, I think the backbone for a lot of these asset allocation portfolios, whether it's from some of the big firms, or we're talking about the robo-advisors, even some of the target date funds and things, are using modern portfolio theory kind of as the basis for putting together those portfolios. And where I think that comes into being problematic is that modern portfolio theory, again, is using these very long time horizons that show the risk and return characteristics and how these different assets are correlated with one another. But there are times when the stock market may go through these kind of structural bull and bear markets, where it may go 10 or 20 years where it's just on this really great run up, and there may go through periods of time where it's in one of these bear markets. We saw one of those bear markets, most of us did, firsthand when the internet bubble crashed in 2000. We saw about a 50% drop in the major market indexes and the stocks, and then a little bit of a recovery for a couple of years. And then in 2008, we saw another 57% drawdown in the major market averages. So that decade ended up being something a lot of people refer to as the lost decade, which stocks lost about 10% cumulative over that 10-year period. And so, and that's actually relatively one of the shorter bear market periods we've had in history. We've actually had some that are much longer than that. So if that, if we've got a long time horizon, that may not be that big of a deal, because maybe some of these other investments are doing halfway decent and everything. But most of us as individual investors, we barely have 40 or 50 years of time horizon. And if we're talking about people that are getting very close to retirement, our time horizon might be 20 or 30 years, And so is that enough time to have that modern portfolio theory kind of shake itself out? Because stocks are going to be a lot more volatile than bonds. If we go back to our 60-40 split, we would actually have to probably have the reverse of that. We'd have to have 40% stocks and 60% bonds in order to kind of counterbalance that level of risk. So modern portfolio theory kind of, I think, has a few problems there that most of us don't have those long time horizons. So Harry Markowitz's original research, that was more intended for pension plans, companies that have a 100-year plus time horizon. If you think of like a charitable foundation that's managing a big pool of assets that, hopefully that foundation is going to be around for a long, long time, 100 years plus, then they can let the ups and downs of all those different market cycles kind of sort themselves out. But when we're talking about retirees, and especially retirees that are going to start drawing some of that money down, we need to think about that a little bit differently. So modern portfolio theory, in my opinion, isn't all that it's shaped up to. Ask your advisor, ask your provider of the investment that you're looking at, are they using modern portfolio theory? Kind of goes by some different names sometimes. So sometimes they can kind of sneak in there in disguise a little bit, but you'll kind of know, if they're kind of buying a little bit of everything, they're probably using some form of modern portfolio theory. And if we go back to this chart right here, what a lot of times modern portfolio theory accounts will do is they'll kind of do something like this. They'll probably have most of the money, if we're just talking about that stock piece, most of the money will be in large cap stocks, maybe a little bit less in medium stocks and a little bit less in small. And not necessarily where they're always going to have these blended stocks, but they're going to have, probably somewhat of an even split between growth stocks and value stocks, and a little bit less in small cap, a little bit more in mid cap, and a little bit more than that in large cap. And that's how they diversify it, because their theory on this is that there's no way of knowing whether growth or value is going to be in favor, or large companies or small companies stocks are going to be in favor. So let's just have a little bit of everything. We'll manage that to an appropriate level of risk. So that's one way of doing it. Again, not my favorite way. Kind of a little bit of a take on that is what's called strategic asset allocation. And strategic asset allocation, that's hard to say, is something where they're basically taking that modern portfolio theory, but then maybe they've got some market gurus that are going to maybe kind of shift that or tweak that up a little bit. So, for example, they might have somebody that say, hey, we're looking at the geopolitical environment and we're looking at what's going on now politically. Maybe they're concerned about the trade war talks and things like that. So they're going to say, hey, right now we're going to shift the amount that we have in international stocks and lower that amount. And they do that. And usually, oftentimes, what they'll do is they'll do that by a little bit. So let's say their target of the portfolio is to have maybe 20 to 30% in international stocks. That seems to be kind of the place that most of these portfolios kind of arrive. And so if they're saying, okay, we're going to have a little bit of an underweight in that, they might underweight that. Maybe they'll put it down to 15, maybe they'll put it down to 19. And it's got the appearance that they're doing something with that. If they're really overweighting that, they might go a little bit higher, but they're kind of falling within a range there of how that asset allocation is. Another great example, in fact, I actually read a piece here. Some of you are familiar with Tony Robbins. He's the big motivational speaker. He's written a couple of books here lately about money, and he got together with Ray Dalio, who's one of these big hedge fund managers. And Ray Dalio has a hedge fund. I think it takes $5 million or something just to get into it. Ridiculous amounts of money. But he wrote a book, and he said, here's the all-weather portfolio. And actually kind of wrote this down. So he says, hey, based on kind of this modern portfolio theory and the risk and return relationships of these different asset classes, he suggested a portfolio that had 30% stocks, so relatively low compared to what a lot of these are recommending. And then you have 15% in intermediate term bonds, 40% in long-term bonds, and then he also recommended 7.5% in gold and 7.5% in other commodities. So we had like 15% of the portfolio in some of these other areas that, really, in my opinion, may have long periods of time where they can underperform. And a great example of that is gold. And so back in the early 80s, you remember we had this big, huge gold boom in the late 70s and the early 80s when we had all that big inflation, and gold got up to about $800 an ounce, I think in 1980 or 1981, and then that was the peak. And then gold kind of traded down for the next several decades, and really I think went down to as low as maybe $270 an ounce. So it was a big drop. That was maybe in the late 90s, mid to late 90s. And then we started getting a rise back up again, and it didn't hit $800 an ounce again until 2008. So if you think about that, there's like 25, 28 years where gold, had you bought that and had made that 7.5% of your portfolio, number one, you'd be down, but would you have the wherewithal to keep that? And then gold, you see all the commercials now on TV where everyone wants you to buy gold because they talk about it as one of the best performing asset classes here over the last 10 years or so, mostly because of what we just talked about there, those two big declines that we had in the stock market, and in particular the 2008, that's when it really started to take off, and gold ended up going up well over $1,600, $1,700 an ounce. I think it's somewhere around there now, but you get the idea that these asset classes kind of move in kind of patterns, or they kind of move in somewhat of a predictable manner, we think, in a lot of cases there. So anyway, so you want to pay attention to that. And then the last type of asset allocation is kind of what we do, and it's something called tactical asset allocation. And we kind of do a little bit of a spin on that, where we're not completely tactical. So a completely Tactical asset allocation would be that, hey, we like stocks right now, so we're going to put 100% of the money in stocks. We like international, so we're going to do 100% international. We don't like stocks, we like bonds or cash instead. And you do these really big, massive changes, from one asset class to another. We do more of we refer to it as a tilting process. And so, we would give these different asset classes some ranges. For stocks, for like a moderate portfolio, we might give it a range of between 20 and 80% invested in stocks. Cash could be a component of the portfolio, and sometimes we might have as little as 0% in cash. Sometimes we might have as much as maybe about a third, 35% in cash. Same thing for international. It might we might keep maybe always at least 5% internationally, but it could be as high as maybe 30 or 35% invested internationally. So we're letting the portfolio kind of swing. And how do we do that? Well, we look at these different asset classes and even some of the individual styles and how they move. They tend to go for a while. They don't tend to change, from one day to the next. So it's not like value stocks are in favor today and then growth stocks will be in favor tomorrow, or even from 1 week or 1 month to the next, because these trends tend to go on for multiple years. So this might be, like we said, our growth stock style there, and it might go up for multiple years, 1 year, 2 years, 3 years. We hit the peak, and then that starts to go down. And maybe value stocks have maybe been, at least in comparison to growth stocks, they may not necessarily mean that one's going down and one's going up, but it might be that growth stocks are averaging 15% and value stocks are averaging 7% or something like that. So they're just not doing as well. And so we have value stocks that are kind of relative to growth coming down. And so we might along the way start to say, well, hey, these value stocks are getting pretty cheap. How much cheaper are they going to get? Because maybe they're making pretty good money earnings-wise, but their stock price just isn't reflecting that. And on the other hand, these growth stocks might start to get really expensive and say, how much longer are they going to go up? And so what we want to try to do, and what we try to do, is look at the trend. And so if you think of it like this, perfect market timing would be to say we're going to buy here and we're going to sell here. And that is impossible to do. I wish we could do that, but we can't do that. But what we can do is we can look at when does that momentum shift. So if we're comparing even just growth stocks to value stocks, when does that shift? And it might not be, it's not going to be at the top, I can tell you that, but somewhere maybe fairly close to the top, we start to see that, hey, relative to what we're seeing on the value side, we're starting to see that shift. And so we can then realign our portfolio. So we're going to, as we're putting this together, we're going to overweight maybe one of those categories that's doing well, underweight, or maybe in a lot of cases completely eliminate those other categories. And we think that adds pretty significant value to the portfolios that we manage. We do the same thing with bonds. And we didn't talk a lot about that, but there's just not one kind of bond. In fact, there's all kinds of different bonds. There's long-term bonds, there's short-term bonds, there's corporate bonds, there's high quality, there's low quality, there's international bonds, there's secured bonds. There's a million different categories, almost maybe more categories with bonds than there are with stocks. So we see the same thing there in how we kind of allocate this across all those different asset classes. So anyway, I hope this makes sense. The big thing I want you to take away from this, though, is maybe understanding, how your portfolio is constructed, and the big thing is process. What is the process for putting that portfolio together, and value that maybe a little bit higher than performance, because if you have a process, hopefully that process is going to be repeatable. That's the whole point of it, is that you have something that you're going to methodically go through, and this is what we're buying, this is why we're buying it, these are the things that would have to change in order for us to maybe sell those investments and change them to something else. So you have a process, and that's important because when you're going through volatile market environments, and here in 2019, we've gone through a couple just in the past year. At the end of 2018, we had a pretty significant sell-off. We just had a pretty significant sell-off here in the month of May. We go back to some of those bigger declines like 2008 or 2000 to 2002. Panicking is probably one of the worst things that you can do, and not having a process for making some of these changes and saying, hey, I'm watching the stock market drop. I'm watching my portfolio lose value month after month every time I get one of those statements, and it's down 10%, and it's down 20%, and 30%, 40%. At some point, do you just throw in the towel and say, hey, I can't take this anymore, get me out, move me over to cash, and then you move to cash and you say, wow, at least I'm not losing any money anymore, but you've already locked in all of those gains. And then sooner or later, the stock market starts to come back up, as it usually does, always does, and you're going to see the stock market going up, and then you're going to miss a lot of that upturn. And then maybe one day you're going to say, hey, I think it's time to get back in the stock market, the coast is clear. It's been going up for the last 4 or 5 years. All my friends are talking about returns that they're making in the market. Maybe I should get back in. And then hopefully that's not right before, but for a lot of people it tends to be. And we see this in mutual fund flows. We know that more people buy mutual funds or buy equity investments, stock investments at the top of the market, and they sell at the bottom of the market. That's just, we see the numbers. We know how much money is going in and going out. So having a process can hopefully help to maybe eliminate a lot of that panicking and say, hey, we've got a process to say when this happens, we might take a part of the portfolio and move it out of stocks, but it's going to be systematically done at hopefully an appropriate time. And it won't be at the top. We don't want to say that we got market timing here where we can pick the top of the market, but we're going to look and see when that trend crosses over there. So value that process as you're putting together the portfolio. If you're working with a financial advisor, hopefully they can explain this, and hopefully I've done a pretty good job explaining this and how we do it a little bit. But if you'd like to learn a little bit more about that and kind of understand our process, if you go to moneyevolution.com, we're going to have some resources there. One of our pages is our Wealth Vision financial plan. You can go to wealthvisionplan.com and you can learn a little bit more about our financial plan, which is the place that most people start. Everyone starts there pretty much, and it's going to lay out your goals, what you want to do for retirement, kind of understand your cash flow a little bit, and that kind of creates the framework to develop this asset allocation for you. And then we can also talk a little bit about how we do this. I can run through some charts with you so you understand it a little bit better. So anyway, hope you liked the video. I hope you got some great value out of it. I know this was probably a little bit longer video than some of our others, but if you like it, hit that like or subscribe button, and also too, share it. If you think there's people within your social circles that might be able to benefit from this, share the video. We'd like to get the word out there. And with that, I'll see you soon in one of our next videos. Have a great day. Hey, thanks so much for watching this video. And if you found it helpful and you're thinking, hey, this makes sense, and you want to have us help you put together a plan for your retirement, then go to wealthvisionplan.com or click on the link below. When you get there, you'll see some information about our Wealth Vision Comprehensive Financial Plan. If you like what you see on that website, then click on the Get Started Now button and we'll set up a time to talk. Thanks, and I'll see you back in one of our next videos. Have a great day.